Welcome back. Another week, meaning another portfolio update video. The US portfolio currently sits at $9,552 US dollars, or 13,306 Australian dollars, down a bit from last week as the market has been a bit volatile. Apple, a major piece of my portfolio, fell over 3% in the past week, along with other stocks, which I believe is healthy. The stock rose quickly on good news and is just a small correction. Apple will bounce back sooner than ever and doesn't worry me, along with many of the other stocks that all fell. On the other hand, Alibaba had a great week, up 7% after constantly getting beat down week in, week out for over a year now. But after Charlie Munger, a billionaire investor who has become arguably the face of investors still supporting this company, has doubled down. According to a Tuesday filing on the Securities and Exchange Commission, Daily Journal owned 602,060 shares of Alibaba as of the end of 2021, a stake worth $71.5 million. That's almost double its holdings as to the prior quarter, when the Daily Journal owned 302,060 Alibaba shares, valued at the same time at $44.7 million. Munger, who turns 98 on New Year's Day, has bet even more on Alibaba as the stock continues to fall due to its concern on a crackdown on big tech firms from Beijing, as well as worries of slowing earnings and growth at Alibaba. Shares of Alibaba plunged 20% during the fourth quarter of last year after losing nearly half their value in 2020. I also sold out of my Goldman Sachs position and put that capital into QQQ, a Nasdaq tracking index fund, and VOO, an S&P 500 tracking index fund. The reason for this change is I just felt more comfortable and saw more upside and potential moving my money to those ETFs. At the end of the day, I'm a long-term investor. Even though I plan on tracking this portfolio every week, I'm still too busy to check up on every stock's news and financials. So I plan to make my portfolio and narrow it down to just investments I truly believe in. And Goldman Sachs is a great company, but I felt more comfortable with my money elsewhere. Another major change to my investment journey is I will be opening and funding an Australian investment portfolio. I live in Australia and I figured it's something I've been wanting to do and think it's a smart thing to do. Investing in Australia, I will learn more about my own economy, and I feel like I've learned a lot about the American system. And I think it's time I learned more about my own country that I live in for now. Next week, or in the coming weeks, I will deposit some funds and talk about it and say where this money is going. Now to cover some general news. In the US, some very disappointing news came out, as the US posts a disappointing 199,000 new jobs last month. The Omicron surge could make it even worse. Though unemployment fell to its lowest level in nearly 2 years, the US added back to a worse than expected 199,000 jobs in December, signaling the labor market is still struggling to add back jobs lost during the pandemic, amid the looming threat of the Omicron coronavirus variant. December's new job gains were significantly less. The roughly 422,000 new jobs expected by the economists, according to the data released February by the Labor Department, spurred by a monthly decline of 12,000 government jobs compared to the gain of 211,000 jobs in the private sector. Despite the worse than expected report, the unemployment rate clocked in at 3.9% compared to the 4.2% in November, hitting its lowest point in more than a year, but is still well above pre-pandemic levels of about 3.5%. The number of unemployed people in the United States fell by 483,000 to 6.3 million, which is much better than the pandemic highs around April 2020, but still more than 5 million in February 2020, the government said. How the latest surge in COVID cases will impact the job market's recovery. The Labor Department surveys around the 12th of each month, meaning it will take it more than a few weeks before the Omicron economic impact is reflected in the data. Moody's analysis chief economist Mark Zandi, wrote in the weekend note. In a Tuesday email, Mark Hamrick, a senior economic analyst at Bankrate, said it's difficult to measure the economic impact of the Omicron variant at this very point and cautioned against dismissing its potential, pointing out the widespread worker shortages, stoked in part by the lingering concerns over the pandemic, remain a big uncertainty. Economists surveyed by Bankrate said the variant could weigh on job growth in the first 3 months of the year, but estimated the unemployment rate will fall to 3.8% in a year. Zandi shared a similar word of caution, saying the risks are rising and forecasting the economic recovery is set to turn soft as Omicron stunts business. Amid the latest surge, credit card spending and restaurant bookings have already dropped substantially, while widespreading flight cancellations have been another economic concern, Zandi notes. As the US faces these employment issues, another major player in the economy of the nation is its crazy housing market. An article in Forbes spoke about this topic. The article is called 2021 was one of the best and one of the toughest years for housing. 2022 will not be so different. Sam Chander, the writer, said, depending on your vantage, 2021 was either one of the strongest or one of the most challenging housing markets in a generation. Across a range of government and private measures, housing prices have posted the largest year-over-year increasing, rising a record-shattering highs in nominal terms. Prices have catapulted past the 2006 peak and are 10% to 50% higher after adjusting for inflation. In turn, housing opportunity has declined to its lowest point in at least a decade, as measured by the National Association of Home Builders and Wells Fargo, moving home ownership further beyond the grasp of many American families. Amid the issues of a supply-constrained market, buffeted repeatedly by the pandemic, October's S&P CoreLogic Case-Shiller Index was 19.1% higher than a year earlier, off only slightly off its peak in August. For the same period, the Federal Housing Finance Agency House Price Index increased 17.4%, while the month-to-month pace of the appreciation has been slowing. It remains nearly double the long-term average and is easily outpacing private sector wage gains. Overall, as someone who has yet to own any real estate and has been looking into it and gaining a greater understanding of the market and the current state that not just my local country and market is in, but also globally, what is happening in other continents across the world, how they are being affected by this surge backed off the pandemic, inflation, supply issues, and demand at all-time highs. All of this information about what used to be an almost guarantee for most in developed countries, the idea of growing up and getting a stable job, settling down and purchasing a house while still young, and living and raising a family in that area, these days are now long gone. I personally am no longer looking for just real estate in my area. I'm looking at the other side of my city, the possibilities of moving estates, or even country one day. Broadening my knowledge on the topic as I learn more and grow older, these raises in price does strike conversation between myself and peers on what truly is the likelihood of us being able to afford and own a home. Overall, my portfolio went down $321 over the past week in total. Thank you for watching. If you enjoyed subscribing, tune in every Saturday for weekly portfolio updates through the ups and downs of the stock market and more general business news to keep you updated. Leave a like and comment your thoughts, and tune in next week.